Hello, and welcome to our conversation on financial reporting. In this session, we'll observe the financial numbers of Augmont Enterprises Limited, whose IPO is now on, and it'll close on August 25, 2026. So let us listen to the numbers. Who knows, sometime all that glitters may be profit too. Augmont Enterprises is an integrated gold and silver platform in India, serving businesses and consumers with a presence of across 24 states as of 31st March 26. Its operations span across the multiple segments of the gold and silver value chain. It has on procurement, its presence is there in procurement, refining, and distribution. It sources gold from domestic and international banks. It imports dory bars and scrap gold, that is procurement. There's two massive refining facilities, um, and then it has about 20 spot delivery centers spanning around 13 states, that is distribution, and the endpoints deliveries are fulfilled within 2 working days to jewelers, the bullion dealers, and asset management company. So for the entire value chain, the company operates as an integrated pan-India physical supply chain. It operates in two business verticals through distinct online platforms. One is called Augment Spot platform, which looks after the enterprise sales, which is also called B2B sales, and the consumer focused offerings through the Augmont Gold for All platform, where they're directly retail customers, they deal with the retail customers. B2B, they buy, refine, the company buys, refines, trades gold and silver, and supplies bullion. The main customers are jewelers, bullion traders, institutions, and asset managers. In B2C, the consumers, it's a digital gold, coins, jewelry, gold loans, recycling, etc. And there it's a individual customers. But we can see that 86%, as per the latest report, 86.8% of the sales are from the B2B, that is the Augmont Spot platform. 6.505% is the international sales, and the consumer-facing B2C contributes to 3.2% sale. So majority of the sales come from the B2B. And that is where the enterprise sales, this particular app is the Augmont's platform is Augmont Spot, is a fully electronic over-the-counter delivery-based bullion platform that became operational in 2012. This platform enables businesses such as jewelers, bullion dealers, and manufacturers to purchase gold and silver bars online with an assured physical delivery. And it's important to observe that deliveries are typically fulfilled within 2 working days, as mentioned earlier. It's also important to understand that Augmont is involved in a sale of gold bullion to asset management companies in exchange of the units of gold exchange traded funds, ETFs, and they trade in gold and silver ETF units. So they give gold, Augment gives physical gold to the fund managers, and instead of getting cash, the company receives ownership units of the gold ETFs. And these ETFs can be traded at any time. This means Augmont also buys and sells ETF units in the market rather than just exclusively dealing with the physical gold and silver. Now let us see the revenue. In the last 6 years, the revenues have gone up from 20,000 crore to 94,000 crore. In June 2021, that is Jan 2021, it is 20,641 crore. And over a period of time, gradually the revenues have been increasing and continue to increase throughout these years. And the latest year is 94,000 crore. And it's important to understand, as per the prospectus, it's also one of the risks of this revenue that the top 10 customers account for about 52% of the revenue. Top 10 customers. In fact, the largest one customer account for 27% of the sales. And this is not the case with only the latest year. This has been happening. There is a concentration of revenue among these 10 and 5 customers. Later on, we'll see that this largest customer is also the related party, which raises further concern. And of this 94,000 crores, majority of that comes from the B2B sales. All the 3 years, we can see that the majority of the sales are from the B2B customers, and a small portion is from B2C. But what is important to notice is that despite having such a huge revenue, the profit is very small, 76 crores, 227 crore, and 348 crore, respectively, in the last 3 years, as per the prospectus. So it is necessary to understand why the margins are so low, why the profit is so low when the revenue is so high. In fact, the margin, the profit as a percentage of revenue is less than 1%, all through years. What is the cause behind that? Reason behind this low margin? This is a company which is high revenues but with low margin. The low margin is due to one of the important components of expenses, that is the cost of material. The cost of the material, the cost structure is attributed to a big portion of a large chunk of the cost or expenses of the company is attributed to the cost of the material. The cost of the material consumed, which represents the cost of dowry bars, which are acquired from outside and within India, and other unrefined gold and silver for the refining operations. And they also purchase stock in trade, which represents the cost of the refined gold and silver they buy from the bank. So this cost of material accounts for a significant part of the total revenue. We can see that the cost of material has increased from 34,000 crore to 93,500 crore, which is in the range of 94.4 to 99.4 to 99.7% of the revenue. So majority of the revenue is going out in the form of cost of material. Other expenses like salary, interest, depreciation are very, very small percentage of revenue. So the managing the profits of this company is managing the top line, that is revenue, and managing the cost of material, that is the major expense of this company. And we can see that the procurement, the company procures material, the gold and silver from domestic suppliers as well as international suppliers. But all through 4 years, 3 years, we can see that a majority of the acquisition, the purchases, are happening from the domestic. Around 75 to 78 to 81% of the total procurement is from the domestic suppliers. And what do they procure? So they procure the gold, uh, which has increased. The volume of the gold procured increased from 33.6 metric tons to 65.5 metric tons. The Dore bars procured increased but it's been ranging between 10 to 14 metric tons. Similarly, the scrap and silver procurement is happening. The refined gold and silver generally procure from the Indian and international banks, whereas the Dore bars, which are a bit unrefined material, the metal comes from the import and then refine it. The scrap gold and silver from individuals, jewelers, and jewelry auctions are also procured, but majority are this refined gold and silver from Indian banks and international banks. It's important to understand that managing the profit of the company is managing the cost of material. But the cost of the material to a large extent depends on the price. The price is very volatile. We can see that the gold price in the last 6 years has increased from 4,000 rupees 4,000 per gram to 14,600 per gram, more than 4 times during this period of 6 years. So the cost of material depends on the quantity purchased, the purity, as well as the price at which the material is procured. And price is not directly in the hands of Augmont. And as we mentioned, a large chunk of the purchase happens from the national and international banks. For example, they buy about 19% from HDFC Bank. Around 20% of the purchase happens from HDFC Bank Limited. And these 10 suppliers account for about 74% of the total purchases. This is also one risk factor. There may be a need for diversifying the sources of purchase. Now let us see the balance sheet of this company. The capital, the authorized capital of the company is 545 million. The face value is 5. They are to have preference shares, and of these authorized capital, the issued and paid up capital is 417.5 million rupees. In the process, they have issued about 83 million equity shares. We have seen that the capital is around 4 to 42 crores, and the reserves have gone up from 55 to 865 crore. But it's important to observe and also interesting, which we will examine a bit more later. The borrowings are very, very small percentage of total sources. So Augmont is more an equity-driven company, and it is asset-light company. You don't have much assets on this type of business. As we already observed, the net profit of the company has increased to 348 crore in the year ending March 26. But in that year, it's worth observing that the cash from operations is negative. However, though the return on sales, the margins are low, the return on equity is around 35 to 40% in the last 5 years. Because the debt is so low, the debt equity ratio in the last 4 years has been less than one. And there is a reason why the debt equity ratio is so low. We'll come back to that in one of the future slides. Now let us see the IPO. How much IPO? The IPO, the total size is around 10.46 million shares. The face value is 5, and the issue price through a book building exercise, there was a ban, but the issue price is around 788 rupees per share. And of this 10.4 million share, 7.8 million is a fresh issue. And offer for sale is, let me correct that. Offer for sale is OFS is 2.6 million shares. So the total size of IPO is 620 plus 205, that is 825 crore. But out of 825, only 620 will be received by the company. Augmont Enterprises is a out and out promoter driven company. Before the IPO, 92% of the stake is with the promoters and the family members of the promoters. And post IPO, because of the new issue as well as the offer for sale, the promoter stakes goes down to 81.9%. So the balance after the IPO, around 18% will be with the public and other institutions. It's important to observe, and it's as given in the prospectus, there are already anchor investors. Who are these anchor investors? These are institutional investors to whom Augmont has already sold the shares, and that is around 32.25 lakh shares at the same price, 788. So 246 crore has already been issued and sold to this anchor investor. Who are these anchor investors? A majority of them, about 50% of this investment is done by the fund houses like Nomura, which accounts for about 50 crore, Tata Small Fund about 35 crore, Nippon India Small Cap 32 crore, and HDFC Mutual Fund is around about 50% are already been subscribed by these people and balanced by other small players. But it's important to understand that anchor investors cannot directly sell the shares in the market, dump the shares in the market immediately on the date of listing and make huge profit, because that may create imbalance in the market. Therefore, the SEBI has put a restriction on that, which is called mandatory lock-in period. For Augmont, 50% of the anchor shares are locked up to November, up to 26th September, and the remaining 50% up to November 25, 2026. So these fund houses cannot sell the shares. Let us see the price. The price which the company has quoted, that is 788, is around 19 times of the earnings. And it's important to observe that the P ratio of Augmont is in line with its competitors, peer comparison. So the price seems to be not unreasonable. It is in line with what the industry P ratio, the nearest competitors belonging to this industry, all of them have around 10, 11, 18, and 19. And the P ratio of Augmont Enterprises is around 19 times. Price is 19 times of the earning. So since all these companies have made a listing gains in the range of 6 to 30%, so there is an expectation that Augmont will also, the investors will also make some listing gains on the date of listing. But an important question, which is necessary for us to examine, why IPO? The revenues are high. The company is able to meet the revenue by having a reasonably good inventory management. Why this IPO? The prospectus very clearly spells out the why requirement. The requirement of funds is to future working capital requirement towards the maintenance and scaling up of inventory. As we observed in one of our previous slides, 99% of the sales is going towards inventory. So if they want to increase sales, they have to increase the material procurement. For that, there is a huge amount of money required. And that money cannot come from the borrowings or loans due to certain regulatory restrictions. So this has to come from the equity issue. So the out of 620 crore, 465 crore will be around 75% will be used for the inventory related issues. And the company's business is actually revolves around the purchase and sale of inventory. The profitability is driven by the volume because the margins are razor thin. The only way the company can earn more profit is by selling more. To sell more, they have to procure more. There is no other way. And so it is more a management of working capital. So managing working capital is one of the important business characteristic of this type of business. And therefore, the company is keen to raise money to improve their working capital finances. The future working capital requirements are influenced by the already fluctuating prices we have seen, the volume, the procurement cost is directly influenced by the fluctuations in the gold and silver prices. And these are not just under the control of the company, these are all under international and domestic factors are responsible for that. So the company is planning to increase revenue. The revenue has to be increased to manage increased profit. So the strategy is to increase the number of customers to whom they can sell gold, silver, bullion, and tier 3 and tier 4 cities. That is a huge demand. That is what the prospectus says. And in order to increase this penetration and service capabilities, the company plans to set up new physical delivery centers across these cities. So the procurement is extremely important for that purpose. This is where it's important to observe. The companies falling in this type of industry, there is an restriction on the debt or the borrowing. The company cannot access debt financing from the commercial banks for funding working capital requirement due to a master direction of Reserve Bank of India. And as a result, the only way the company can grow is through internal accruals. or the equity funding. And that is what is happening. We can also see because of this, the debt financing, the debt equity ratio has been very low. The debt has come down from 178 to 17 crore, whereas at the same time, the equity has gone up. The debt equity ratio is very, very low. One of the reasons for that, or the main reason for that, is the restriction put by the Reserve Bank of India. There is a one major concern which is flagged off by the prospectus is a related party track. In fact, this is not only in this company. Whenever you observe an IPO prospectus, it is very important to examine and see the presence of related party transaction. And in this type of companies, it's more important because it's a revenue-driven company and the cost of material accounts for 99%. And if a significant part of this revenue and the cost of material are from related parties, then definitely we have to be careful, There is a need to investigate, examine those transactions. And what is important to observe, one of the related parties was also promoter is a Riddhi Siddhi Bullions is a promoter group entity, and this is Augmont. It's 27% of the total revenue out of 60 out of 60s or whatever amount of total revenue, 25,000 crore, which is 27.4% of the revenue, is to the Riddhi Siddhi Bullions. So this is a sales between two related parties. In the same way, 6.3% of the total material procured is from Riddhi Siddhi. So these are significant amount. And not much details are provided that though the prospectus says that these are at arm's length price, one need to keep a watch on this type of transaction. So a big chunk of this transactions may affect the revenue if this increases further, and if there is no corresponding cash flows, there is a possibility the company can have profit, but no corresponding cash from operations. So let us keep a watch on this related party transaction. So way forward, the company has been doing well. The revenues are increasing, notwithstanding the related party transaction. The company has been digitally, technologically savvy, has been using the technology to increase the sales, increase the market, go to tier 3, tier 4 cities, reduce the inventory cost by reducing the delivery period. So there is a strong growth story, plus the use of technology. So the company seems to be having reasonably strong fundamental. The valuation, as we already saw, it is in line with the industry. The P ratio is not extremely high. It is within the range of what the competitors are. But should someone apply for the share? I leave it to you. Keep a watch on this company and understand the sector. And more important is understand the volatility in the price and observe carefully these related party transactions. Thank you very much.